Fundamentals of Investments Management, INV2601. Today we are covering study unit number 14, which is Portfolio Standard Deviation and Correlation. We have a bit of material ready, prepared for you. And if you do like what you were doing last week with my colleague, then it's going to be a great day today. Lots of practice questions. And I hope we'll go through as many as we can regarding this chapter. Remember, if you have questions which are outside this study unit, you will still have the that discussion forum online. Let's make use of it. I was online today checking if there are any questions which I might have missed or we might have missed, and there were no questions. And I know there are lots of you who go to the study, to that discussion forum, look, and go leave and not comment on anything. I know there are lots of people who go look on there. Let's engage there. If you have questions, ask them there. But if we have time at the end of this lecture, which is highly unlikely, if we have time, you can ask about anything. But remember, we have that discussion forum. Okay. Let's get started today. Let's see what we start with. Obviously, we start with something I like doing. Something to do with study technique. So something will pop up on your in the chat and in front of your screen. I have other hobbies where I learn other things. Oh, I missed the word. Than the usual classes and work. I have other hobbies where I learn other things, other than the usual classes and work. That's a lot like me, sounds like me, a little like me, not much like me. Make your choice, make your choice, make your choice, make your choice. Let's see, how many people do we have so that I know how many people, how many answers to expect. I might be waiting for people who are not there. Oh, we have 22 people. So if we do 15 responses, we will be doing fine. If you don't see a pop-up in front of you for a poll, you can put your answer in the chat. So the question is on the slide. So it's the same question on the pop-up. So you can put your answer in the chat if you don't see it. I have 23 people. I will not be happy to only see 11. Let's push the number to about 15. And then we'll assume that maybe the 8 wouldn't respond, can't see it. That number is stuck at 11, ladies and gentlemen. Just make a choice, Because this one, there is no right or wrong answer, because I want it to prepare us to start this conversation. Maybe my chat is not moving, okay? Okay, Mojag says a little like me, that's better. Sounds like me. Okay. Okay. Why I'm asking you this question? Because having other things, having other hobbies outside work and classes is important. What does research say? Let's see. So I looked at 2 research results. Okay. So there was a program which was done for older adults. In other words, for old people over the age of 65, where they were trained on the piano for 4 months. And you know what? Compared to those people who were not trained, those people who were trained showed that their executive function, the executive function is the ability to make decisions, improved. Inhibitory control, it means that ability to control yourself, that improved. They no longer had too much divided attention. It reduced depression. It improved motor abilities, to say they were more flexible. Now they could walk better. Those were old people. That's why that was important. Then there was similar study done on children. They were taught a musical instrument. We showed that they improved verbal and mathematical performance. Why am I telling you about this? It's important, ladies and gentlemen, to have other hobbies where you learn things as an adult. It helps with your studies. It also helps with your work. I'll tell you an example. When lockdown started, I started learning the guitar. First time in my life. It was the most strange thing. Because you see, now we want to play, to control two hands doing different things. Oh, it was hard. But the fundamental lesson which I learned there, ladies and gentlemen, is repetition is not a problem. Because after sitting 4 or 5 times a week, you still can't play the guitar. You still can't change chords to say from C to A, from A to E. You can't do that. So if you train yourself to say, learning is the ability to repeat things which I don't necessarily enjoy, but I want the outcome. If you teach yourself that while it's playing an instrument, now when you're doing your studies, when you see difficult things, it's still the same. I'll tell you, when I started playing the guitar, it was tough. It was tough. It was tough. And because now I wanted to look at my other hand, strumming the strings, I want to look at my other hand to change how do you do that? But with perseverance, after a month, I could play, those 2 chord songs or 3 chord songs where you just change 3 times. But now when I'm learning things, now when I started learning how to play the piano, it was impossible, but it was no longer as impossible as when I started playing the guitar. And I always say to myself, if I was doing an undergrad degree, it would help me much, because there are times when I was doing my undergrad, when I gave up, I saw a difficult concept. I said, no, it's too difficult. But now after playing the guitar, I say, it was impossible to play the guitar, but after a month, I could play. Okay, that's what I wanted to say today. Before we do so today, our plan of action, we are going to talk about asset allocation, portfolio return, correlation, portfolio standard deviation. It's not going to be difficult, ladies and gentlemen. It's going to be a blast. Easy stuff which you can relate to. But you know what? I always think when I'm talking, I'm not teaching. But when people are answering questions, they are learning. Okay, so as a person who wants to minimize investment risk, okay, I should, option 1, buy shares of an international company with a history of good performance. Option number 2, invest in a portfolio of shares. Okay, answer that, make your choice there. And whilst I'm looking for someone to mute, I'm gonna mute someone. I'm so sorry to mute you, but we need the line to be okay. I think my colleague already muted. That's good. Thank you, Yumna. Thank you very much. We need the line to be clean and clear. 6 responses. Let's have more people, ladies and gentlemen. We have 31 people on this line, and 6 is too few people. Just make a choice. Make your choice. And if you can't make a choice or if it doesn't show as a pop-up, if you look in your chat, you can make a choice, or you can type your answer in there. Like Lorato, investment in portfolio of shares, I will choose for you option 2, and I'll say submit. Done. Anyone else who wants to type something in? Okay, the numbers are coming. It's good. If we have 33 people, maybe let's aim for 20 responses. Okay. Now we have maybe in 17. Okay, let's say what was Mojagi investment in a portfolio of shares. So my 2 votes are done. 18 people. One more person. One more person to make a choice. Mantombi, Elizabeth. Perfect. So most of you got it right. I would invest in a portfolio of shares if I was interested in minimizing investment risk. Okay? So most of you are right. I will invest in a portfolio of shares. But I have another question. If you are investing in a well-diversified portfolio, because I 100% right, you invest in a portfolio of shares to minimize risk. But now, next thing is to say, if you are invested in a well-diversified portfolio, you only face which type of risk? Systematic risk or unsystematic risk? Let's make a choice. Let's make a choice. Let's make a choice. Let's make a choice. Quick choice, ladies and gentlemen. If you are not sure, you can just choose anything. You can just say, my mother told me to choose this one. That's what I used to do when I was young. My mother told me to choose this one. I don't know whether my mother would have told me to do. Okay. Mantombi says, systematic risk. I'll make a choice for you. Kuda, Nalo Kuda, nice to see you, Kuda. You also say systematic risk. Okay, who else? Lorato says systematic risk. Mojagi says systematic risk. Let's have one more person. Okay, we got one more person. Okay. Okay, so most of you got it right. In a well-diversified portfolio, you only face systematic risk. Okay. So people invest in portfolios to diversify or to reduce the risk they face. Because when you are invested in a single asset, you are facing too much unsystematic risk. Or we can say you are facing too much company-specific risk. So when you are invested in two portfolios, when you are invested in a portfolio, not all portfolios are the same. Portfolios differ based on the assets they invest in. There could be a portfolio which invests 50% in MTN, 60% in Vodacom. That can't be a portfolio. 40% in MTN, 60% in Vodacom. Oh, that's a very risky portfolio. 20% in Old Mutual, 20% in Sanlam, 20% in Vodacom. Someone is ruining our life there. Yumna, someone is really ruining our life. Okay. So different portfolios hold different types of assets. Some portfolios are fully invested in shares. Some portfolios is a combination of shares, bonds. Some portfolios is only bonds. Some portfolios is bonds and money market instruments. Different assets. Different portfolios also face different levels of risk. For instance, a portfolio which is 70% invested in shares is more risky than a portfolio which is 70% in bonds. Different portfolios are also managed by different asset managers. So it might be 70% shares, 70% shares, but it could be different managers managing that portfolio. So the most popular portfolio in South Africa is called a unity trust. So if you go to Stanley from Standard Bank, Unity Trust. If you go to Sanlam Investment Managers, Unity Trust. If you go to Old Mutual Asset Managers, Unity Trust. So that's the most popular type of investment. There is also some of you are members of provident funds. All those investments are unitized. So you are invested in portfolios. You are invested in different kind of portfolios, unified portfolios. Why do we do that? In order to minimize risk. Now, I want to talk briefly, very briefly, because I'm seeing my time there. So this is a relationship between risk and systematic. This is a linear illustration of unsystematic and systematic risk for those two people. So we say if you are holding one asset or one share, you are facing a lot of unsystematic risk. You see where there's D there. But that unsystematic risk, it starts to reduce, continues to reduce, continues to reduce, continues to reduce, as long as you are increasing the number of securities. So the moment you start increasing the number of securities, we say you are diversifying. And the more you buy more securities, you get to a point where your unsystematic risk is completely gone. That well-diversified portfolio we're talking about. It's completely gone. We are only faced with systematic risk. So in theory, there's a theory which says between 10 and 15, that's where you are completely diversified and you're only facing a systematic risk. The way I'm a simple man, the way I remember systematic and unsystematic is to say, systematic is to say a risk which affects the whole system. Unsystematic is just a company-specific risk. So when you say systematic, I think of a system. Unsystematic, not a system, which means it's company-specific. Okay? I'm talking too much. I have to ask you a question. Which investor should have a higher government bond allocation in a portfolio? Now we are trying to apply what we are learning. Because I don't want to meet you one of the days, ladies and gentlemen, you saying I did investments, but you don't understand the issue of risk in a portfolio, what assets should be in a general portfolio for your own retirement benefits. Or when you are getting older, or when you are young, to say, I'm reinvesting for this, for retirement. What type of portfolio should I have? I'm expecting when you finish this module, which is like in the next few months, you have a solid understanding. So which investor should have a higher government bond allocation in a portfolio? Tash in a 60s, investing for retirement at age 65. Tandy in a 20s, investing for retirement. Okay, let's see your choices. Let's make a choice. It's only 2 choices, ladies and gentlemen. It's not too hard. And let's see how many people do we have. We have 30 people. Okay. Make your choice, make your choice, make your choice. So Lorato says, Tash, let's make a choice for you. Lorato, submit. Kuda says a bond. Okay. 60s bond, what were you saying there? Oh, Tash. Okay, so yeah, we are agreeing with Lorato there. So I'll make a choice for you there. Let's see if there's anyone else. Mojaki says Tash. Okay. So we have 18 responses. I think we are good to go. So we are saying an investor, Tash in his 60s should invest more in government bonds. 100%. Because of the lower investment risk that government bonds offer. As compared to Tandy still has a long time to get to retirement, so she can invest in a risky portfolio. Okay, let's see someone to mute. Okay, we have muted someone. Okay, so now next question. Why am I wasting time? Don't waste time. What do you think is the most important determinant of portfolio investment performance? I'm just giving you the general theory before we jump into calculations. What do you think is the most important determinant of portfolio investment performance? What do you think? Make a choice. Make a choice. Let's see. Okay, risk. That's what Mojagi thinks.
I chose the risk, sir.
Kuda says asset allocation. Okay. Kuda says asset allocation. I like it when there are differing opinions. Now we have a decent distribution. Nomsa says risk. Abelina says asset allocation. Okay. I think we have enough people to move on. I think we have enough people. So the most important determinant of portfolio performance is asset allocation, ladies and gentlemen. Okay, let's go and let's see what does the slide say. So when we talk of asset allocation, we are saying what is the asset mix? What are the assets which make up a portfolio? That's asset allocation. So the asset allocation drives the level of risk, but that's the most important aspect of a portfolio. The most important determinant of investment performance is asset allocation. And they say it contributes 85 to 95% of investment performance. That's how important asset allocation is. So when people are making the most important decision is to say, if I want to maximize return, the types of assets you have and their proportion in the portfolio is the most important. But when we talk about asset selection, we are saying which assets have we chosen in our portfolio. That's asset selection. But before we talk about correlation, we need to calculate what we call weighted return of a portfolio. Remember, we said a portfolio is a combination of different types of assets. So now we want to say, when you want to identify or determine the level of portfolio return, we do what we call a weighted return. So what is a weighted return? We are saying the weight of an asset times the return of that asset, plus weight of asset 2 times the return of that asset, plus, okay, spare us the details, John. That's how I can hear people saying that. So we have our portfolio here, our two portfolios. So we have our portfolio A and we have our portfolio B. As you can see, our portfolio A, both portfolios are made up of old mutual government bonds, treasury bills, and corporate bonds. But portfolio A is 15% old mutual shares, 59% government bonds, 22% treasury bills, 4% corporate bonds, and expected returns for old mutual 10% government bonds, 8% treasury bills, 5% corporate bonds. Okay, so what is the weighted return of portfolio A? Okay, that's what we are going to do in the next slide. That's good, that's good, that's good. So to find the weighted return for portfolio A, we go to the bottom here. We say 0.15 times 10, which is that times that. 0.59 times 8, 0.22 times 5, 0.04 times 7%. It gives you 7.6%. So we are multiplying this and this, this and this, this and this, this and this, and adding up the result, which gives us 7.6%. Ladies and gentlemen, I think you know what I'm going to say. Your one is this one. The B. Calculate the weighted return for portfolio B. That's yours. Yours freely. Once you get your answer there, I will put up a poll. I created a poll in the morning. Today I didn't have a lesson early morning. So I had lots of time to fiddle with slides, to create more polls and all those things. So when you find your answer, I'll give a minute for people to do the calculation. And then I'll put up a poll. Then you can just choose your answer. So if the pop-up is blocking your slide, you can close it, ladies and gentlemen, because the pop-up will still be on the side. I can see my watch is saying 10:55. When it says 10:56, we will reveal the answer. One more person. There's one person who's typing. Once they post, then we can continue. If you are, okay, I'll show you the answer and then I'll talk about if you are unsure, then we can just, oh, okay, we have even more people posting. That's even good, even better. So here is the answer, ladies and gentlemen. Okay. Abelina, you made a cardinal mistake. You know what? Cardinal. An important mistake. You're rounding up too much, Abelina. It's 11.96. 11, you rounded up too much. Okay. Ladies and gentlemen, anyone with a question about getting this answer, or should we continue? Because I don't like to teach people things they already understand. Because if I look at my poll, which is why the good thing about the poll, I can see that all of you got it right. Since I'm not going to teach about it, we can continue. Okay. Now we are going to talk about one of the fundamental concepts in investments called correlation. So when we talk of correlation, we are talking about the relationship between two types of assets. So we are saying different assets behave differently under different conditions. Oh, that's so sophisticated. Okay. But when they behave so different, so we are saying, let's say if you were holding a share for mining versus a share for a bank or for a supermarket, they don't behave in the same way. So if you had a portfolio with shares for a mining company and another, let's say you have a share for Vodacom and MTN, we can see that they behave in a similar way because they are the same kind of company. Different companies, but they are same type, they are the same business. Shares for Old Mutual and shares for Sanlam, they should behave in a similar way because they are shares in the same type of business. Shares in ShopRite and shares in Checkers behave in a similar way. But if you are holding shares in a hotel versus shares in a bank, they would behave differently. So that relationship is what we call correlation. So if it's a perfect relationship. So if it goes up, if one goes up by one and the other one goes up by one, we call it perfect positive correlation. Perfect positive correlation is equal to 1. So if it's a negative correlation, which means if one asset goes up by 1%, the other one goes exactly down by 1%, we call it negative correlation. But since it's so perfect, we call it perfect negative correlation. And that is equals to -1. Okay. You are talking too much. Show us something, John. Yes, I hear you. So perfect positive correlation is what we see in the box there. Okay, let's see if my pointer is showing there. Oh, my pointer is there. perfect positive correlation. You can see they are going up at the same rate. It's a straight line. So the perfect positive correlation is equals to 1 because our correlation can only be between 1 and -1. So this is perfect positive. If it's negative, to say if it goes up by 1, another one goes down by 1, perfect negative correlation. Then if there's no relationship, it's just however, there's no relationship between. So if the economy does well, we don't know which assets will do well. Okay, there's no relationship, correlation. So this correlation would be close to 0, or this correlation is going to be 0. Okay. Correlation is important in portfolio management because it determines how much risk you can reduce. You cannot, with great confidence, say I have a portfolio which is diversified if you are holding a ShopRite and a Checkers share, or if you are holding a Momentum and Old Mutual share, because we know there is a strong positive correlation. Insurance companies, all insurance companies currently, they are suffering because of COVID. So whether you are holding an Old Mutual share or a Sanlam share, they are suffering because they have a positive relationship. So if you want to diversify, why correlation is important? If you want to diversify your portfolio, you need to hold a portfolio with negative correlation. So that if you win one, you lose one. You win one, you lose the other, okay? You are talking too much. I agree. I am talking too much. I need to ask a question. To reduce risk, you invest in. Make your choice. Five more seconds. No one posted anything else, so I will just make my own choice. Okay, so most of you know what we are talking about. Most of you know that if you want to reduce risk, you invest in assets with negative correlation. Okay, so okay, we spoke about this. In fact, with negative correlation. Okay, now we can move on. Okay. Okay, so before I show you the next slide, I have to talk about this, otherwise you say you just came to us without warning. So the different managers follow different approaches in investments. So they are what we call active managers, and then they are what we call passive managers. Active managers, actively, that's not a good explanation. Active managers buy and sell assets on an ongoing basis. So they look for opportunities and buy. And they assume that this share is not going to do too well and they sell it. That's active. They actively participate in the market, looking for opportunities. Then there are what we call passive managers. Passive managers, they look at the market and they say, there isn't much we can do. Let's just mimic what the market is doing. Those are as passive managers. So passive managers then, therefore, do not actively buy and sell. They go and hold an index. So if you're a passive manager on the stock exchange, you are likely to go and buy the all share index and hold it. Because you are saying there is no advantage which accrues to you from buying and selling. Okay. So that when I ask you a question, you won't say you were not prepared. Okay? Now you are prepared. There is your question. I told you I didn't have a lesson before this lesson. So, you know, when I don't have a lesson, then I fiddle with the slides and find more and more questions. So this was one of past exam papers, which I found. Because I had plenty of time on my hands. I finished these slides like on I think on Wednesday or on Thursday. They were ready. And last night I finished the polls. I created all these polls and put them up. So from the time I woke up to about now, to about 10:30, I was just waiting. That's when I started seeing some of the interesting questions in past exam papers.
Sorry, sir.
Yes.
How are you?
I am good. How are you?
I am also good. So I heard that you were talking about the past papers. I want to know that which one do we have? Because I only find 2017 only.
Can't hear you. Can't hear you anymore.
I asked that. I heard you that you said we were talking about past papers.
Yes.
So I want to know where can I find them, because I only got 2017 only in past papers.
I think there's don't we have a practice past question paper? I think we have a practice one.
Or in group.
Normally,
Yeah,
good morning to everyone. The practice pass questions are normally they're loaded on the main site, but at the moment I can't actually tell you which tab, but maybe additional resources or official study material, it should be there. But I will have a look and post on the discussion forum.
Yeah, thank you very much.
Okay.
Thank you. We will check there.
We check the 100%. Okay, so we are saying, okay, let's see. Let me make it. Let's see which of the following is okay. Let me just go to the next. Let me go to the next slide. Okay, now we have passive. Okay. Let's see the question. Maybe in case I chose the wrong one. Which of the following is a strategy of constructing and holding a portfolio of high quality pre-selected shares without endeavoring to constantly outperform the market in short term through superior forecasting? Okay. So ladies and gentlemen, this is passive. Remember I said active, you are buying and selling. Active, you are buying and selling, but passive, you buy and holding. So the moment they say hold here, what did they say? Following holding there. The moment they say holding, you should know that it's passive. And without endeavoring to there. Okay. Okay. Now you should do better in the next question. There's the next question, obviously. I like this question. I found it. Look at that one. I found it this morning. Remember, I was just playing. This is what I do for fun. I found it and I said, this is a good question to ask. So before we start doing calculations, this is a good question to ask. Shares A, B, and C each have the expected return and standard deviation the same. following tables show the correlation between the returns on these shares. Which one? Given this correlation, the portfolios from these shares have the lowest risk. If a portfolio is, then you make a choice. Then you put your choice in there. In the poll. If you get this one right, it means you understand, fully understand. But I think you should get this one right. It's easy. Which means you fully understand what correlation tries to do. Make your choice, ladies and gentlemen. Remember, if you don't know, you can just say, my mother told me to choose this one. I'll choose number 2 because that's what my mother told me to, without even reading. Okay, I was like, okay, sorry. I was sorry, mother. I was supposed to say, my very clever mother told me to choose this one. Okay, now I choose the option 3 because she's very clever.
I choose
one. Okay, I'll choose for you 1. Okay, I hope you also have a very clever mother like my one. Okay, ladies and gentlemen, make a choice. I'm not happy when there are few people choosing, especially these multiple choice ones where you don't have to calculate anything. Because these ones, if you are not sure, then you can just make a choice. Because if you make a choice, ladies and gentlemen, it means you are committing. When we are talking about it in this next slide, it will make more sense because it's like a person who have voted. You know that my vote was terrible. Okay, Mojaki says option 3. So I will use my last vote because I only have 2 votes. My last vote for Mojaki, option 3. 11. Okay, so we have 11 plus 1, 2, 3. Let's have one more person. Kumo says share B and C, which is option 3. Lindiwe, option 3. Nomsa, option 1. Okay. We can move. Let's move. Option 3 was correct. It's confusing when you look at it, but it's really simple, ladies and gentlemen. Remember, a few slides ago, we said you invest to maximize your diversification, you should invest in assets with a negative correlation. So the only combination with a negative correlation is this one, share B and C, this one which I highlighted there. So there's a long explanation. Remember, I'll share these slides. I will not read through the long explanation, but share B and C because of the negative correlation. It can be that if you have +1, it means it's a perfect positive correlation. So it means you're not diversifying at all. There you're not diversifying. There you're not diversifying. You are diversifying, but you are not maximizing. Here is a very positive correlation, so you are not maximizing. But this one with a negative correlation is the one. Okay. So we were talking about correlation. Now we understand what correlation is. So I think we are all ready to do some calculations. But to calculate correlation is easy, ladies and gentlemen, because there is a formula which says covariance AB divided by standard deviation A times standard deviation B. Okay. Don't worry about this formula yet. We will worry about it, I think, after 11:30. We will worry about this, maybe before, about this formula. So covariance is equals to summation P return A minus KA times return. Okay, don't worry about this one for the time being. Just know that portfolio correlation is covariance AB divided by standard deviation. Ladies and gentlemen, this is standard deviation, not variance. This is standard deviation A, standard deviation B. Okay, don't say I didn't tell you. Now this one is yours. Assume the covariance of the shares M and N is 0.78. The standard deviation of M is 0.56 and the standard deviation for N is 0.94. Calculate the correlation of the shares M and N. Okay? Plug and play, ladies and gentlemen. Plug and play and make your choice. Plug and play, plug and play. Okay, close poll.
564. 0.7 divided by.
I will put a poll up for you to make a choice so that I know how many people have completed. Remember, the poll is a management tool. Okay, I'll put a poll in the next 10 seconds.
I can't action the.
Okay, Desiree wasn't talking to us. If you're talking to us, Desiree, you can unmute yourself.
I say I can't chat because it says I'm not a member of the chat.
Do you know what? It also says exactly the same thing to me. I don't know what happened.
Okay.
But on my, let's say on my backup, because on my backup, funnily enough, on my other laptop, I can chat because I have two laptops on the go. But on the main one, which I'm using, can't. Okay, I'll put it in the chat. I'll put a thing in the chat for you to make a choice, a poll, our usual poll, so that we know how many people have already completed. Make your choice. But I think Desiree, if you go in the chat, you can make a choice in the poll there, because in the poll I can make a choice, but I can't type anything in the box. Option 3, Hulisani says option 3. Okay, submit. Mojagi says option 3. Option 3, submit. Okay, we have 15 people. Let's just say like 2 more people. Just, okay, I might want 2 more people when we don't have people anymore. We have 35. The number has increased. So let's have 2 more people. Okay, 2 more. We already have 2 more people. You know, someone who's difficult to satisfy. That's me. Okay, ladies and gentlemen, let's wait for Mona Lisa. Oh, that's a beautiful name. Mona Lisa. I think I'll go and negotiate with my wife to have another child. Because now we found a name. I'll tell her now after the lesson. Now we found a name for our baby. The factory can open now. Mona Lisa. Okay, let's go. Let's go. Yes, those people who said 1.48, which is most of you, you are such clever people. Only one says 1.23. So the person who said 1.23, you will get a chance to fix your error in the next slide. So you don't need me to lecture you on this one. You know what to do. Next question. Next question. You might be surprised. Is it a new? Yes, it's a new question. This one I will not even give you a hint. No hint provided. And a poll is going to come up in the next few seconds. Keep your answer there. Keep your answer there. I'm giving people a chance to do the calculation without that thing blocking their faces. A poll is going to come up in the next 10 seconds. Poll loading. Poll coming up. Poll coming up. There you go. The poll is coming. I saw this in a past exam paper and I was excited. I saw this. I had only 2 questions for correlation. Then I found this in the past exam. I said, wow, this is a perfect question to ask. Pole loading. Last time we had 19 responses, so we still a bit of a distance to go. Ladies and gentlemen, let's see how far are we. Oh, I am loving this class. Because when I show you the answer, I'm sure you are going to be disappointed. Okay? You'll be surprised they are only, you are confident, but you might be confidently wrong. Confidently wrong. Most of you are rushing, ladies and gentlemen. What are you rushing for? The question says the variance for share A is 3.3. This is not standard deviation, it's a variance. You were rushing. Okay. The variance for share A is 3.3. So you come and say it's the square root of 3.3856. See, now you see why I loved this question when I saw it. And the square root of 5.8. Now I say, why square root? Because standard deviation is the square root of the variance. So when I saw this question, I was so excited. Standard deviation is square root of variance, and variance is standard deviation squared. Okay? So 18 of you rushed into making a mistake. In the exam, that's when you do what my daughter does. I say, how was the exam? Perfect. I think I got 90%. When the results come, I've never seen a 90%. Okay. Now you can do it carefully. There's another question. Now you can do this one carefully. And I'll give you a poll shortly. Okay, poll coming up. Where is the poll? I might need to create a poll quickly. I don't know why I don't have a poll. Who knows why I don't have a poll? I don't know. Why don't I have a poll? No good reason. Let's see. Ladies and gentlemen, it will take too much time for me to create a new poll. Put your answer. Okay, now put your answer. You actually type your answer in the chat.
Hi, say.
Yes.
Since we cannot type, should we tell you, or because I don't have access to the group
To the
chat?
chat, yeah,
Yes.
like me. Okay, tell me.
Option 3.
Option 3. Okay, let's see. Let me quickly do this. So you're saying option 3. Option 3, and you, what's your name?
It's Faith.
Faith. Okay, Faith. Option 3. Who else can't type?
I also can't type, sir.
Yeah.
I can't type. It says
Okay, tell me the answer.
it's option 3.
Option 3, and what's your name?
It's empty.
Huh? Auntie?
Yes.
Yeah. Anyone else who can't type? Desiree, you can't type. Tell me the answer. Okay. So people are committing to option 3. Option 3. Wanted to say option say 3. 0.936. Okay. Okay, ladies and gentlemen, we are all agreeing on option 3. Let's see. Yes. And we are all right. We are all right. Option 3. Okay. Now we go to do what we call portfolio standard deviation. Portfolio standard deviation, all you need to remember, ladies and gentlemen, like what my colleague Yumna was saying last week, is the formula. It's a long formula. Okay, not a long formula, it's just a long formula. So the formula for portfolio standard deviation is equals to weight A squared times standard deviation A squared plus weight B squared times standard deviation B squared plus 2 times weight A times weight B times correlation AB times standard deviation A times standard deviation B. When I did my undergrad, we needed to keep this in our heads. But I think these days they are allowed a formula sheet. Yumna, did you say we are allowed a formula sheet? Okay. Yumna, when she comes online, she will tell us. This when we are doing in our undergrad, okay, now let's calculate, let's find the standard deviation for this portfolio. So you say weight A, you come here and say, what's weight A? That day it is. Go and put it in your there. Go and do this calculation, ladies and gentlemen. Weight B, you can see it there. Standard deviation, it's already given. You put it there. Standard deviation, you put it there. And then you choose your answer there. I don't need to teach you how to use a formula. You already know. And when you get to, let's see if I have a poll for that.
Sorry, John, I missed your question there.
Okay, I wanted to say, did you say we are allowed our formula sheet in the exam? We as students.
You know what? My suggestion to you guys, which is what we suggested last year, was, you know, I would say write down your formulas. Make your own formula sheet because one is not provided for you. So you are allowed to write it down, but let's just confirm with Mr. Matsoma before I offer you guys this option in case things have changed. But if I'm not mistaken, we did advise students to make your own formula sheet.
Ladies and gentlemen, last year it was allowed, so likely this year is allowed. So if you are organized, you can type out a nice formula sheet, 1 page, which you know, so that you don't have to look for it. Don't look for formulas in the study guide in the exam, ladies and gentlemen. That's really crazy. Put it in 1 page.
Yes.
1 page.
Yeah, it's not
Yes.
advisable for you to do it on a plagiarism level. You don't have that time. It's not allowed, but just so that you can refer back and, make sure that you have used the correct or you've substituted correctly into the correct formula.
Formula, 1 page, ladies and gentlemen, type it neatly. You have no excuse not to do well. Okay, there is a poll which is coming up to make your choice. Okay, now this one I think this is my last poll. I'm so sad. This is my last poll. Coming up. Make your choice, make your choice. Okay, so for those who are struggling, ladies and gentlemen, the weight is this 60%. So you can say 0.6 squared times 0.05 squared. I'm helping you with this one because the next one will be on you. Then for portfolio B, you can then say 0.4 squared times 0.1 squared. Then you would have done that part. 2 times 0.6 times 0.4 times correlation. This is, remember, RAB is correlation. Correlation, here it is, minus 0.8. There it is. Then standard deviation, you have 0.05. .05 and 0.1. Then you make your choice. Let's do it quickly so that we can do another practice question. Because the more you do, remember I was telling you about a musical instrument, the more you play the same keys. Now, when I finished playing, I think it was around in December, when I stopped playing my guitar. I could now play without even looking at it. So the more you do these things, the easier it becomes. I could even sing. I could even sing John Legend's song whilst I'm picking strings. So where I was doing picking strings, changing chords and singing. That was nice. And then it just got out of me. I just didn't like to do it anymore. Actually, my fingers were sore. That's why I stopped. I couldn't take the punishment anymore. Make your choice, make your choice, make your choice. Or type. Okay, I'll give you half a minute, then we can continue. So 15 seconds. Seven seconds. 3 seconds. So big review, ladies and gentlemen, to see if you are right. There you are. There you are. So most of you, 10 of you are right. And for those who are still on the road to being right, you can see what happened here. Really, no, something not too difficult. Not too bad. As long as you have the formula, it's a plug and play. So you can see what happened here. Ladies and gentlemen, since we are practicing, there you go. Let's see if we don't have another better question. Yeah, we have to do that one. Okay, let's try this one. Okay, this one I'll give 4 minutes. Let's try this one. 4 minutes. So that at 22 we start doing something else. Still calculate the portfolio standard deviation. The numbers you're dealing with here are very small. That's why I didn't like it. So 2 minutes left. Once you find the answer there, ladies and gentlemen, just post it in the chat. I don't have a poll anymore. I don't know why I stopped. I think I got distracted. One minute. I can see Dineo is about to post something. Dine is about to comment on something because she finished posting, now she's typing something. Ladies and gentlemen, post your answer there. Oh, she's not posting anymore. Oh, Dolly says 1 again. Ulisan says 3. Okay. Ladies and gentlemen, I know this question is not too good. When I was attempting it myself, it is, but it was from a past exam paper still. The numbers are too small. The numbers are too small. Where the numbers were punishing. Yes, so Dineo, you are right. Dolly, you are right. The answer is that one. Not this one, Halusan. I think there's something which you missed. Okay, ladies and gentlemen, let's do something different. Now, may I have your attention? Remember, I will send these slides, and these slides will be posted on the discussion forum. We will post the video on YouTube. We will post a link to that video on discussion forum, so we'll try to make it as easy as possible for you to have access. But now I want us to, it will sound like we are going back to study unit 1. So we have this table which we want to work with. So the first thing we want to do is to say, what is the standard deviation of each asset? But remember, the ultimate goal, if we manage in the next 18 minutes, is to then end up calculating the portfolio standard deviation for this portfolio. So we have our portfolio here with asset A and B, as you can see in economic conditions. So the first thing we want to do is to calculate the standard deviation for A. Why I chose this example? Because I thought it would also help us to remember what we did some time ago. So what is your expected return for A? So to find your expected return for A, remember, ladies and gentlemen, we say 0.1 times minus 25, this one. 0.1, why do we have an answer there? Okay, but we have half answer. 0.1 times minus 25, 0.2 times minus 18, yeah. 0.3 times 9, yeah, at the bottom. 0.4 times 3, 0. It gives you 8.6. This answer I don't trust. Ladies and gentlemen, go and calculate expected return for B. I don't trust this answer. I'm not trusting this, and I think I saw it was wrong at some point, but I don't know why it's still here. Go and do a calculation for expected for B, expected return for B. These are the expected returns, and this is the probability. Go and do this one, and tell me what you find, because I think this one is wrong. This thing. So I will take the first answer which comes. If the first answer gives me something which I think is right, then we correct that one. Of course, there's a correct answer in my head, but it's not on the slide. The correct answer is taking time to come. I'm almost taking matters into my own hands. Yes, Leon, you are right. It's not 0.05, 0.5. Now our slide ran away from us. We have to find it. We have to find it here. Where were we? Yeah, this is 0.5, this one. It's important for it to be correct. Okay, let's save and project. Okay, so the next step, ladies and gentlemen, we are trying to find the standard deviation for finding. You are going to do this standard deviation for B, but I'm going to do with you standard deviation for A. So remember, the formula for standard deviation is RI, or individual return minus expected return squared times P. So A minus expected return squared. So we say minus 25 minus 8.6 squared gives us 11.29. Minus 18 minus 8.6 squared gives us 7.076. 9 minus 8.6, 1.4, I think so, squared gives you this. Why does it look wrong? No, it's not 1.4. It's not 1.4, it's 0.04. Okay. Then we say 30 minus 8.6 squared. So 0.3 minus 8, 0.0, it gives you 4.5. So ladies and gentlemen, go and do your B minus expected return B squared and put it in a column like that. Because that's why we're calculating that. And then when you finish, for those who are quick enough, then you say probability times this number which you get to get P times A minus expected return squared. Then you put it in your column there. Let's do that. Let's do that. If you are not sure, if I am confusing you, you can just say I'm not sure. We are almost doing the last thing. So I'm giving you 2.5 minutes to get to here, to variance. So it's that minus that squared, put the number there, that minus that squared, you put the answer there, that minus that squared, you put the answer there, that minus that squared, you put the answer there. When you finish, you say P times that, P times that, P times that, P times that, you put your answer here, you sum, then you get there.
Excuse me, Doc, what are we busy with calculating now?
We are calculating the standard deviation for B.
For B.
So I have done a calculation for you for A.
Okay. I don't know if mine is right.
Yes.
Negative 0.032326.
What's that? The standard deviation?
For B, yeah. I don't know. Yeah.
I don't think it can be negative because
then,
it will clear all negatives by the square.
Yeah. 0.032326.
Okay, we'll look at it. Yeah. What happened now? I'm coming out of my presentation mode because I'm clicking around. Okay, keep that one there. Oh, because you can't post. You said 0.32326.
Yeah.
Okay, so that's just okay, let's have more. Okay, I'm giving you 1 more minute. Lisan says 0.08. So if I see 1151, it means we are going to the next slide. But yeah, I'm hoping more people will post. Mojakis, your answer is close to 3.2637. 3.26, close to Desiree's one. Now I'm seeing 51. Okay, so let's go to the next slide. Next slide. The numbers are all very small. So our standard deviation is 0.03236. Very close to Desiree's one. So that's the standard deviation for B. Very small numbers. The example is not too good because the numbers are very small. Because some of you can't even get, with your calculators, you can't even get B, or you are getting zeros because after 3 decimal places, it is going to give you 0, cutting off there. I cheated by doing it in Excel. I'm telling you, that's what happened here. That's why I ended up with such small numbers. So if we say portfolio covariance, so to see portfolio covariance, ladies and gentlemen, remember the formula is at the top there in case you are not seeing the formula. The formula is at the top. The formula for covariance is equals to P times return A minus KA times return B minus KB. Okay. Why I'm doing this with you is so that there was a past exam paper which I saw there was need to calculate this covariance. So what you then do, similar to what you do when you are calculating standard deviation. So you are saying A minus KA expected return. So you are saying A minus 25 minus expected return 8.6. That minus that. Okay, sorry. A minus 18 minus that gives you minus 26. 9 minus that gives you that. 30 minus that gives you that. Then you do that with B. Then when you multiply, you get this. So the portfolio covariance 0.0 minus 0.067. Okay. Ladies and gentlemen, I want you to I know that I most likely I forgot to put a question there. I want you to calculate the portfolio correlation. And you know what I'm going to do? Because, okay, no, I don't want you to see that. Okay, I want to come here and to make life easy, I want to go and grab that thing, you know, that thing which copies. I want to show you the standard deviation because you need it. You need it here. So let's see if it will work. Yes, it should work. Best. Okay, so the piece which I brought now, okay, let me project so that now it's the same color, it's really same color. Now we need a pointer, we definitely need a pointer here. So the piece I brought is from the previous slide because I want you to see standard deviation for B, standard deviation for A. I want you to calculate the portfolio covariance. Oh, I don't know whether you'll be able to do it. No, you should be able to do it, man. Because we what do we have?
It's the
We
same.
already have covered. Humnet, I think I posted on the wrong slide.
That's the same screen.
Yeah, I posted on the wrong. Yeah, I want me to post here, paste here. What you need to do, ladies and gentlemen, is to calculate the portfolio correlation here. That's better. We were calculating correlation a few slides ago. Now we have your covariance here, you have your standard deviations here. So I want you to calculate number 3, portfolio correlation. Lorato says you are going too fast. No, I wasn't even going too fast. I was confusing you. I was confused. Lorato, now, okay, now it's simpler now. So I'm saying now we are doing number 3. And you have your portfolio, your standard deviation for A, and you have the standard deviation for B. Now I want you to calculate, and your covariance here. I want you to calculate portfolio correlation. We did that a number of times. And then put in the chart. That's the last thing we're going to do. Now we are back to doing portfolio correlation, which we were doing some time ago, a short while ago. And people are tired, that's the thing. But this is the old formula which we were using the last time for correlation, portfolio correlation. One minute to find the correlation, which we were doing, all of you were getting it right a short while ago. Portfolio correlation. Now the formula is not there, but I can remember it in my head now.
.99. Is that right?
0.99, okay, that's Desiree, okay, let's say it's positive.
Negative.
Negative, okay, yeah, because that's important, negative or positive, negative. Okay, anyone else with a portfolio correlation, ladies and gentlemen, should be easy because we 0.99, denial 0.99. Let's get 2 more people.
Hi, I'm also getting negative 0.99.
Negative 0.99. Who's that?
It's Kumo.
Kumo, okay. Mona Lisa and Dineo, is it 0.0 or is it not? Is just 0.99?
I am also getting negative 0.99.
Okay. That's an only.
Yes.
0.99.
Getting 0.98, which is negative 0.99.
Tokozile. Negative 0.99. Ladies and gentlemen, I think you are right. Let's go there. Yeah. Ladies and gentlemen, it's 11:59. You are right. We won't do the portfolio standard deviation because we already did that. Now we're just building it from the ground up to just remind you about calculating individual standard deviations and all those things. Any questions? Anyone with a question? When people are quiet, it might mean people are tired, which is most likely. But I think you were following. I suppose you were following. Ladies and gentlemen, we have come to an end of our ongoing lectures. We are going to sit around the table. I don't know whether it's just a figure of speech. We are going to have a meeting to say how many revision classes are we going to do, and we are going to communicate with you on the discussion forum. And we're going to let you know what's going to be the next. But next weekend, next Saturday, we are not going to have a lecture like now. We are going to take a hiatus. Okay, sorry, a break. We are going to take a short break. And then I think we will come back to do some revision. Lindy says, I'm tired. Yes. Okay, you are tired. Okay, but I think I think, Yumna, do you think we are going to do review? I think we'll do revision class, 1 or 2 revision classes. What do you think, Yumna?
Yes, definitely. I think more closer to the exam. We definitely have to space in an online class. But like you were suggesting, John, we also want some feedback from the learners or the students. Where you can also suggest to us that, you know what, it's highly beneficial, or you guys will really like revision on certain sections. We'd also appreciate some feedback from you guys.
Yeah.
Well, from my side, I did enjoy this. It was very informative and I learned a lot, and I would have loved this must continue, but I know there is some decisions that needs to be made if they're going to allow you to do this or whatever. Yeah.
Yes, 100%. You fully understand what's going on.
Yes.
Okay, so we are going to sit around the table. Okay, why am I saying sit around the table? We are going to have a Teams meeting and then see there are some decisions which will need to be made to say how many revision classes, so there is a bit of conversation, but likely we are going to have 1 or 2 revision classes.
And in the meantime,
yes.
if I can just re-emphasize what you said in the beginning of the lecture, is let's try and maximize communication from now until those revision classes on the discussion forum. I will try and be posting regularly. And you guys too, now you know Dr. Nyamunda and you know myself. You know who you're talking to, who you're communicating with. So please feel more comfortable to engage with us on the discussion forum in the interim period.
Ladies and gentlemen, it was a pleasure doing this. Teaching is one of my things which I enjoy doing. Even if I'm busy, I always try to find time to teach, because it's one of the things which I enjoy doing, trying to share what I know. And I'm sure Yumna also enjoys doing that, because Yumna was the major proponent to say we can't keep on doing text. Let's go and talk to students. So I'm sure now when we sit around that table, table I keep on talking about, I'm sure she's going to be pushing that very hard, because helping you is why we are here, and trying to make the module understandable is probably that's why we are here.
Definitely. So let's keep in touch then, and have a lovely weekend.
Perfect. I'm stopping recording. Thanks. Bye.
Bye.
Bye.